Welcome back to Journey Realty Group, the go-to channel for all things real estate. Whether you're a first-time buyer, seasoned investor, or just getting started in property investments, today's topic is tailored just for you. How to spot a good investment property, a beginner's guide. Now, I know the idea of finding your first investment property can feel like searching for a needle in a haystack. You're faced with thousands of listings, overwhelming numbers, and a lot of guesswork. But here's the thing. Understanding what makes a property a good investment is the key to building wealth in real estate. It's not about luck, it's about knowledge, strategy, and consistency. By the end of this video, you'll have a complete framework to evaluate any property and determine whether it's worth your time, energy, and money. We'll talk location, numbers, property condition, rental demand, and even red flags you should avoid. So, if you're ready to stop guessing and start investing with confidence, grab a notebook, hit that like button, and let's jump right in. 1. Understanding what a good investment property really means. Before we get into the specifics, let's define what we mean by a good investment property. This is foundational because what's good to one investor might not be good for another. For most people, a good investment property checks off a few key boxes. It generates income. This could be consistent monthly rental income or profits from a house flip. The property needs to make money for you. It appreciates in value over time. Real estate should grow in value, allowing you to sell for a profit later. It has manageable expenses. A property that eats up your profits with repairs, taxes, or other costs isn't ideal. It offers a strong return on investment. The higher the ROI, the better your deal. Let me break it down with a quick example. Imagine you buy a 3-bedroom house in a growing neighborhood for $200,000. If you can rent it out for $2,000 a month, pay $1,200 in expenses like mortgage, taxes, and maintenance, you're left with $800 in cash flow every month. That's a strong investment because it covers costs and leaves money in your pocket. But here's the trick. Your goals matter. If you're looking for quick profits, you'll focus on flipping homes. If you want consistent passive income, rental properties are your best bet. Knowing your objective will help you evaluate which properties align with your strategy. 2. The power of location. Why it's the first thing to evaluate. You've probably heard the phrase location, 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 and there's a reason it's the golden rule of real estate. A property's location can make or break its investment potential, no matter how beautiful the house is. So, what makes a location great? Let's break it into 4 parts. 1. The quality of the neighborhood. Is the area safe? Are the schools well rated? Crime rates and school quality directly influence whether tenants or buyers will want to live there. Websites like Zillow and Crime Reports can help you get a snapshot of the area. 2. The job market. Look for locations with strong employment opportunities. Cities experiencing job growth attract renters and home buyers alike because people move to where the work is. For example, tech hubs like Austin or Seattle have seen massive demand for housing because of their booming job markets. 3. Nearby amenities. Properties near public transport, shopping centres, parks, and entertainment options are always in demand. People want convenience, and amenities boost a property's value. 4. Future developments. This is the hidden gem of location analysis. Research whether new highways, schools, or commercial spaces are being built nearby. Future developments often mean property values will rise. Example. Let's say you find a house in a neighborhood where a new shopping mall and several tech companies are about to open. Even if it's slightly more expensive now, the property is likely to appreciate quickly, making it a great long-term investment. The bottom line, a mediocre house in a great location is almost always a better investment than a perfect house in a declining area. 3. Crunching the numbers. How to assess financial viability. Once you've found a location you love, the next step is to analyze the property financially. Numbers are everything in real estate investment, and if the math doesn't work, you walk away. Here's how you break it down. 1% For rental properties, the monthly rent should equal at least 1% of the purchase price. For example, if a house costs $150,000, it should rent for $1,500 a month. If it doesn't, you might struggle to cover costs. Cash flow. Calculate your monthly cash flow. Take the rental income and subtract expenses like mortgage, taxes, insurance, and maintenance. Positive cash flow means the property earns more than it costs to own. Cap rate. This is a simple way to evaluate returns. Take the annual net operating income, income minus expenses, and divide it by the purchase price. A cap rate between 4 to 10% is generally considered good. Let's do an example calculation. Say you buy a property for $200,000 and rent it for $2,000 a month, $24,000 per year. Your annual expenses are $12,000. That leaves a net operating income of $12,000. Divide $12,000 by $200,000 and you get a cap rate of 6%, a solid investment. The key is to analyze the numbers carefully and avoid emotional decisions. If a property doesn't meet your financial goals, don't force it. 4. Evaluating property condition. Repairs versus renovations. Here's the reality. Not all properties are move-in ready, and that's okay. Sometimes a fixer-upper can be a gold mine, but you need to know the difference between manageable repairs and money pits. Necessary repairs. These are critical fixes like plumbing, electrical issues, or a leaky roof. Value-adding renovations. These are upgrades like new countertops, fresh paint, or updated bathrooms that boost the property's appeal without breaking the bank. Example. Let's say you find a house priced $20,000 below market value because it needs $10,000 in cosmetic updates, paint, fixtures, and landscaping. Once renovated, the house could sell for $30,000 more than you paid, making it a smart investment. Always get a professional home inspection before buying. Small issues can hide major problems, so budget for unexpected repairs. 5. Rental demand and market analysis. Even the best property won't make money if no one wants to rent it. Before you buy, research the rental market in that area. Ask yourself, are rental homes in high demand? What's the average rent for similar properties? Who are the tenants? Families, students, professionals? Websites like Rentometer or Apartments.com can give you rental data, while City Demographics can show you the target audience. Example. A property near a university might attract students, while a family-friendly suburb will appeal to long-term renters. Real estate investing doesn't have to be intimidating. By focusing on location, crunching the numbers, assessing repairs, and understanding rental demand, you'll be able to spot a good investment property with confidence. If you found this video helpful, don't forget to hit that like button, subscribe to Journey Realty Group, and share your thoughts in the comments. Have you spotted your first property yet? Let's hear your stories. Thanks for watching, and I'll see you in the next video.